What's going on, my friends? We are here with yet another market update. And if you have had your head in the sand, you're going to recognize pretty quickly that there has been some stuff going on, not just here in the States, but also globally. So let's dive into it. So one of the biggest stories that's out there right now is SVB. What does that stand for? Silicon Valley Bank. Now, when we think about that, Silicon Valley Bank, how is it even possible that a bank in Silicon Valley would fail, would collapse, and need, we're not going to call it bailout, but you may as well call it bailout because that's what it is. When the central banks come in and say, hey, don't worry guys, we'll help you out, that's called a bailout. So essentially that's what it is, right? Now, before we get all doom and gloom about, oh my gosh, there's banks failing again, and we're going to experience our 2007 to 2011 meltdown, if you will, don't worry about it too much. Yes, it's a problem. Why is it a problem? Believe it or not, it's because of the feds. The feds have their heads so far in the sand, we're going to be nice about it, right? But you know what I'm thinking, that they don't recognize that the indicators that they're using, the economic indicators that they're using to be able to decide if we should keep raising rates are so far behind, be it 3 months or 6 months, or in some cases, just as little as 30 to 60 days. But a lot can change in the economy in 30 to 60 days, and sometimes from week to week. We're not only seeing some improvement with the CPI, but also the PPI, which is the Producer Price Index. Now, year over year, we're seeing about a 5.7 to 4.6 fall, which is great. Considering the peak of where we were with inflationary numbers, we're probably double that, right? So this is a good sign that what is happening by the feds having increased the rates by so much, so fast, and continually at almost every single Fed meeting, that yes, it's starting to fix itself. But the problem is like, look guys, the medicine's already in the economy. You already did that. So let the medicine do its job. You don't have to keep shoving medicine down its throat to make it better, because what you're doing now is creating issues, much like we've seen with the bank in Silicon Valley or one over in Europe, because essentially we are a global market, that it is impacted them to the point where they can't even afford to stay afloat, right? And why is that? Because I don't know if you guys have looked, but if you go and check it out, the short-term rates, okay, which if I go and put my money into a savings account, normally I would tell a consumer, look, where's your money sitting? And if they go, oh, well, I have it in the bank. Okay, well, do you have it in the checking or savings or whatever? If it's in a savings account, on average, to see anything north of 1% is incredible, right? On a savings account. And you can find them out there, sure. Right now, what are you seeing? I'll show you one here in the illustration below, but this bank is offering 4.2%. I happen to come across this by talking to one of my colleagues, and we'd noticed it on a bank statement. 4.2% on a short-term savings rate, you could barely even get that on a CD. But the problem is these short-term rates are paying more than the long-term rates, right? So banks have to make money on our money. If they can't do that because the spread is negative or inverted, as you may hear in the news, then they're forced to do what? Shut down, close up shop, sayonara, put a sign on the door, get out, right? But don't worry, because the central banks and the feds will come in and save the day. I wish I had a job that I could do and continually screw it up and then not only keep my job, but make some really darn good money while I'm doing it. Incredible. Now, let's talk about some positives here, because eventually what will happen, my friends, is that the feds are going to soon recognize, March 22nd is the next Fed meeting, by the way. The feds are going to soon recognize that the aggressive rate hikes are starting to hurt the system, starting to hurt the economy more than they are helping better it, right? But and we can get into all the logistics about the labor markets and the this and the that. You're welcome to read through the show notes and get some more information and click on some of these links if you're curious, because I'm curious too, so I get it if you're that type. So feel free to dive in. But listen, here's what's going to happen, most likely, and we're crossing our fingers that this is going to happen, that as the Fed start to recognize that they have risen rates too much, too fast, and continually just try to force this medicine into the economy, which really isn't needed anymore, let's just hold tight and sit tight, right? The expectation in the last Fed meeting was that we were going to continue to raise rates, and we don't need to do that. We don't need to do that anymore. So the hope is that come March 22nd, the Feds won't raise rates again. And anytime in the future, in the near future, not future entirely, but in the near future, because right now we don't need it. We don't need any more medicine, as they're calling it, right? That's the one variable among a handful of others that they can control to help lower or raise inflation. Income increases, yeah, have gone up, but not relative to the rate hikes or to the cost of durable goods or to the cost of gas or rent inflationary numbers or housing market inflationary numbers, right? Our dollar does not go as far. Let's be real. If we look at the last 81 years, so since 1941, the record of market appreciation for housing is this: 73 years of those 81 years has seen market appreciation. Okay, guys, let's really think about that in context. Okay, if you had a winning record that was 73 and it's actually 73, 7, and 1. The 7 are market depreciation, which was largely in part to programs that were put in place from a lending perspective that shouldn't even have been a thing, right? If you had a heartbeat, you could get a loan. And that shouldn't have been a thing. Like, I put my head down at night back in those years and said, hey, look, let's figure out one person's ability to repay, which in our world is called ATR, ability to repay. And while, yeah, I get that people are self-employed and sometimes their net income isn't as big as it should be, but they could have distributions and other things coming in from other areas, and they can show signs that they have the ability to pay. Or better yet, maybe they put a larger down payment, which helps curb the risk. At any rate, the loans that were in place back then during those 7 years of decline, which were mostly in part due to the 2007-11 era, there was another blip in time, which you can see, but that was because of stupidity in the economy, right? Let's not throw loans at people, stated income, this, stated that. Well, that's because the market was appreciating so high, so strong that they were banking on the fact that the asset, the house, was going to continue to increase in value. So it didn't matter if they didn't pay. Why? Because then the bank would take it back and sell it for a profit. So, or the person that couldn't pay would be forced to foreclose, and if they didn't foreclose, and there was equity, they would sell it first. But guess what? The market collapsed. The two biggest issues during this decline, the biggest one from 2007 to 2011, were two things. One, we had an overabundance of inventory, not enough people to buy. That was because of the birth rate roughly 20 years prior was not near as big as it is now, or in the last, say, 10 years, or prior to that. It was more of an anomaly. You combine that with the bigger issue, which was, hey, guess what? We're just gonna lend anybody because the market's appreciating and we don't care if they have a job or if they don't. Essentially, if you have decent credit, and even then, the credit guidelines were far less restrictive than they are today. We're just smarter about it today. We can still do stuff that's crazy and out of the box. We just have to be smart about it, okay? Anyway, so there's that. Now, remember, guys, this is the thing. The Feds need to stop and think about this as a marathon, not a 100-yard dash. Let's just slow down and not continue to raise rates. Let the economy adjust for itself moving forward, and let inflation come down, right? As inflation comes down, rates come down, people are more willing to list, listings go up. We're not back in this market appreciation. They're almost forcing market appreciation, which is insanity. But anyway, it will come back around. Stay positive and stay tuned. We'll talk to you guys soon.